Welcome to PwC IFRS Talks, your source for all things IFRS. I'm your host, Raihazah Shaikh. The topic for today's podcast is a summary of developments with respect to IFRS 9 classification and measurement. Now, I must admit this is a topic that's quite close to my heart. I've worked on many classification and measurement queries over my time in the accounting technical team, so I am really quite excited to be discussing this on IFRS Talks today. And joining me on today's podcast, I have Laura Kennedy and Mark Randall. Laura is director in our Global Corporate Reporting Services team, specialising in all things financial instruments related. And Mark is an IFRS 9 specialist who leads PwC's Global IFRS 9 Classification, Measurement and Impairment Working Group. Welcome to IFRS Talks, both.
Hello.
Hi, great to be here.
I would say in my time in the technical team, when it comes to IFRS 9 queries, often the focus does tend to be towards the impairment side of things. But interestingly, I guess over the past year or so, we have seen a number of issues relating to classification and measurement becoming more prominent. Now, part of that was through reflections following the post-implementation review. And then, of course, we have market developments and issues that have arisen, for example, through IFRIC that have been referred to the board for narrow standing setting. So let's begin by a quick overview on the post-implementation review, or the PIR. Before we dive into the specifics on the IFRS 9 PIR on classification measurement, I think it might be a good moment just to take a quick step back to explain what the purpose of the PIR is and what the ISB hopes to get from the PIR. So maybe if I look towards you, Laura, perhaps you can share some thoughts on this.
Yeah, absolutely. So I guess post-implementation reviews, they happen after the first few years that a new standard has been applied. So really once practice has started to learn the ropes with the standard and any kind of implementation issues are being ironed out. And at that point as well, a few years after the standard has been applied, you can start getting some trend analysis there as well, which is helpful. And really the point of post-implementation reviews, it's really just an opportunity to gather feedback to figure out how well has the standard been performing in practice, and has that standard met whatever its specific objective was. And that objective is generally lined up with somehow providing useful information to investors. I guess one thing that I always find quite interesting about PIRs is that actually, if you think about it in some sense, the ISB is almost continuously performing PIRs. And I guess when I say that, what I'm trying to say is, as soon as the ISB puts out a standard, it's constantly monitoring its implementation and its application. We have transition resource groups that happen soon after a standard comes out. There's the IFRS Interpretation Committee that's there to deal with application questions. And just more generally, the ISB stays plugged in with its stakeholders and is ready to act if there's something that needs to be done with one of its standards. For me, one of the interesting questions is, why is there then this formal PIR process when all that is already continuously going on? And I guess for me, the whole point of doing a specific PIR project is that really the board can do a full holistic assessment where all at once it gets the feedback from across the world and across all different stakeholder groups. And I think when it does that, it can look into not just what's the hot topic and the big urgent topic right now, but maybe can realize some of the other areas that, while they're not a burning issue, if you look across all the feedback, might be worth a little bit of extra attention. I guess one thing maybe to mention is a post-implementation review, and I think we've learned this in the few implementation reviews we've had so far, is it's not intended to answer every single application question that we have. That's really is something for practice to do, and the interpretation committee is there to help practice if needed. And it's not there to reopen the many old debates that there often are on some of these big standards without looking into any new information. So there's a relatively high hurdle for taking standard setting forward from one of these projects when you bear that in mind. But it does happen. So I think the outcome of a PIR can be some standard setting projects. And I think that's what we're about to talk about today.
Thanks, Laura. That's really helpful context for those, I guess, PIRs that are still to come in the future. So, we are expecting the PIR of IFRS 15, PIR of IFRS 9 impairment, IFRS 9 hedging, and then IFRS 16. So lots to come either later this year or, within the next year or so. And I'm sure we'll continue to monitor them and update our users as they progress. So back on the topic of PIR of IFRS 9 classification and measurement, there was, a fair amount covered. And I think those that are really interested can always refer back to the ISB's feedback statement, and we can include a link to that in the talking points that will accompany this podcast. But for the benefit of our listeners, can you summarize what were some of the key areas the board decided to consider further?
Yeah, sure. So in this classification and measurement PIR, actually, I think probably worth starting out with mentioning that the overall theme of the PIR was positive. So there were no big fundamental questions or challenges about the principles and the objective of those requirements in IFRS 9. But saying that, the board has picked up 3 key things to take forward. It's got 2 matters requiring action as soon as possible. And so those is the exposure draft that's out at the moment. And then there's also a 3rd item, which will be coming further down the line. So the ones that it's been put forward to have some action that's going forward right now, the first one is to do with assessing whether financial assets have contractual cash flows that are solely payments of principal and interest, which indicates which measurement model you'll use for those financial assets. Would they be amortized cost or would they be fair value? And in particular, the questions that the board has been getting there, a very hot topic right now, is how do you make that assessment about whether the cash flows are payments of principal and interest when you have interest rates that are linked to ESG targets? And the second question that we've got coming up that's being dealt with is talking about the timing of when do you recognize and de-recognize amounts when an entity settles some kind of payment using an electronic cash transfer system, which might have a couple of days between the payment being sent and the payment being received. So those are the ones that I think we'll talk about most today because they're going on now. And then maybe I'll just mention briefly the other topic that we've got coming further down the pipeline, which is the board might look into research on whether it needs to do any clarifications relating to how you do accounting under the amortized cost measurement method. And in particular, that's in response to questions in practice about how do you deal with adjustments in cash flows when you use an effective interest rate method. That third one is a bit more of a mixed bag in terms of feedback. I think some people in industry felt that the effective interest rate method was well understood, while others said that it's something that raises a lot of questions, particularly relating to whether the guidance in IFRS 9 on floating rates applies or not. So yeah, those were the 3 things that were picked up.
Thanks, Laura. I think it is just helpful context in terms of understanding where things landed from the PIR's perspective. So, as mentioned earlier, I think for the rest of the podcast, it'd be helpful to do a deeper dive into the 2 key areas that the ISB decided needed more immediate attention. And a reminder, those 2 areas, firstly, were contractual cash flow characteristics. So that would include financial assets with sustainability linked features and contractually linked instruments. And then secondly, electronic cash transfers. So Mark, maybe I can turn to you now on this. So can you begin by perhaps providing a background on the first of these issues?
Yeah, so the contractual cash flow characteristics you talked about, there's kind of 2 clusters in there. The first is around the ESG features that Laura touched on earlier, and this question as to if interest is linked to ESG limits or metrics, does that mean the instrument can still be considered to have payments that are solely principal and interest and be eligible for amortized cost accounting? Because people are typically very sensitive to not getting amortized cost accounting, being required to measure at fair value and the volatility that can come through from that. So that's kind of one key area. And then, yeah, the other that you mentioned there is contractually linked instruments. Now, these are kind of almost a standalone set of rules for structures such as securitizations where there's a waterfall and payments are prioritized in a sort of preordained manner. But the feedback was that kind of people struggled in interpreting where the boundaries were for when that contractually linked instrument guidance should or should not apply. So that's kind of the other key area.
In terms of the next steps on this one, we understand it was added to the work plan as a separate project, and it was proposed to produce some narrow amendments to IFRS 9 as part of the exposure draft. Can you perhaps talk us through what some of those proposed amendments are?
Sure, yeah. So again, if I maybe break that down into the kind of those two clusters. So the first, which was prompted by these ESG-linked loan assets, what the proposals do is not actually a solution just for ESG-linked clauses. The board were very clear that they felt the general principle behind SPPI and kind of what instruments are eligible to amortized cost worked well, but therefore they wanted to clarify it. So really what they've done, and I'll work backwards here, that the most specific guidance is there are proposed two new examples, one of which is sort of a pretty classic ESG linked loan, where the ESG targets are specific to the borrower, and the example makes it clear that that passes SPPI. There's also another where, rather than having regard to metrics specific to the borrower, it looks to like a market price of carbon and says that fails because it's not specific to the borrower. So there's those examples, but then to underpin that, there's additional guidance going into like the body of the literature on how you work out whether a loan or an asset, financial asset, has got the basic features that mean that amortized cost is appropriate, and gives some more guidance there around if cash flows are contingent on the occurrence or non-occurrence of a particular event, that event needs to be specific to the borrower or the debtor, and also that when those cash flows change in that sort of a situation, the direction and the amount of those adjustments has got to be aligned to the change in the basic lending risk. So effectively not being compensated for something else, or you haven't got an investment in the borrower. And there's also some added new disclosures. So they're the key components of the proposals that kind of emanated from that user request of we need clarification on ESG linked. And then separately on that contractually linked instrument guidance, there'd always been some questions around how or whether and how you applied that guidance if in the pool of assets that's giving rise to the cash flows that are supporting your instruments, there's requirement to see if they pass SPPI or not themselves, the underlying pool. And what is being clarified is that those instruments could be things like lease receivables that themselves aren't in the scope of IFRS 9, but you still got to apply that test of would they pass SPPI. So there's a clarification around that. And there's also a new paragraph that looks at quite a specific situation where a contractually linked instrument transaction has only got two issued tranches, and one of them is actually bought back by the sponsor of the structure. So kind of to cut a long story short, it's a complicated area, but when you look at the lender, they are the only party holding an issued tranche externally, and for that reason, it clarifies that the view to apply is that doesn't then fall into the scope of the contractually linked instrument guidance. So a relatively techie situation, but if it applies to you, it matters. And often if you get dragged into the scope of the contractually linked instrument guidance, it's a lot more difficult to pass SPPI for the instrument you're looking at. So that was really the motivation behind that.
Thanks, Mark. I think that's really helpful just as an overview in terms of what the amendments are. So what are some of your reflections on, I guess, what we're hearing in the industry on the proposed amendments? Perhaps areas that they are interested in or areas that are likely to be more challenging, for example?
Sure. So again, if I start off with the changes driven by the comments on ESG, I think pretty universally people like the clarification that loan assets that have got interest linked to ESG can and will pass SPPI. I think that's really helpful and really goes to the core of the feedback the ISB got, which is this is a huge growth market, uncertainty about accounting, potentially risks impacting on that market. So I think that's really good. I think the questions I'm hearing are slightly perversely not about those instruments, but these changes, what do they mean for other things and particular instruments we might never have thought past SPPI. Reading some of these new changes, some are saying, well, these criteria, I could see many features seeming to pass them that aren't just the ESG ones, and kind of what was the intent to have potentially kind of that much wider impact, or and therefore off the back of that, really getting into the detail, how should we read these new requirements. So I think that's one area. And then I think kind of another area I would flag is people looking at certain clauses, in particular what's often referred to as increased cost clauses, and saying what does this new language mean for those? And just as an example, an increased cost clause might say that a lender is able to charge a higher rate of interest and pass through cost it's suffering if there's, let's say, a change in a tax or regulatory environment impacting on the lender. Typically, that they are not considered to be an issue for SPPI, but because of the new wording in the proposed amendment that talks about if there is a trigger linked to a contingent event, that trigger has got to be specific to the debtor. In many instances, these increased cost clauses aren't specific to the debtor. Like I said, they might have regard to like wider industry dynamics like tax and regulation. So I think there's kind of questions as to, are we reading this right? And if so, is the intent to cause a problem with it? I don't think it is. So I think that's something that will need to be worked through. And I guess the other aspect I would flag is it's rare that there are changes to a standard without accompanying changes to disclosure. And the feedback the ISB heard when they were discussing the ESG features was, I think, quite a strong level of interest from users saying we perhaps hadn't appreciated the extent of these types of clauses, and that sort of interest income, which we saw as quite a stable metric, that actually it might change as a result of these clauses, that where the occurrence or non-occurrence of events could either change the timing of cash flows or the amounts of those. So there's a new disclosure requirement to really unpack, both for financial assets but also for financial liabilities. Well, what are these types of clauses? How many of your instruments do they affect, and what impact could they might have with quantitative disclosures? And I think really two reflections there. Some people are saying, well, there's some existing disclosure requirements that to us look pretty similar for liabilities, so we're not quite clear why this new requirement is also including financial liabilities. And then secondly, even for financial assets, there are some types of clauses that seem to be caught, that people are saying, well, we're really not sure that's going to give information that's particularly useful to users of the account. So specific example there would be things like penalty interest, where, yes, if a borrower misses a payment, the interest rate steps up, but people would often say, well, the reason they've missed that payment is because they're struggling to pay the original contractual cash flows, let alone increased interest. So actually, in reality, we don't expect that increased interest really to be recovered. And so is understanding the existence of these clauses and the prevalence, is that really particularly useful information? So I think that's one to reflect on. To their credit, the ISB have got wording in the proposal that does permit some flexibility, but I think people are questioning, does that give you enough flexibility to exclude some of these clauses in their entirety? So that's one of the things to think about. And I think people are just worried about the extent of effort that might be required to trawl through all their financial assets and all their financial liabilities to pull out these clauses, if the benefit to the user when they get that information is not going to be kind of proportionate to the effort required.
Thanks, Mark. So it's an underlying theme there, just in terms of possible wider implications and what that means for existing contracts. So if we move on to our second topic then, that's on electronic cash payments. Laura, perhaps I can turn back to you. Can you remind our listeners of the background on this issue?
Yeah, sure. So this one's probably at the opposite end of the spectrum to the one on solely payments of principal and interest, because it starts with what you might think is a relatively easy accounting question. So there was a question that came to the interpretations committee as how this one came about. And it was all around, when do you recognize cash? So if you have a trade receivable and you're being paid through an electronic cash transfer system, for example, there's the BACS system in the UK, when do you recognize the cash you're receiving and recognize your trade receivable as well, using the requirements of IFRS 9. And the reason this question came up is that a lot of electronic payment systems generally have a few days between when the payment is initiated and when the system has fully settled that payment. Given it's a few days, most of the year round, this doesn't cause an issue for your accounting. But if your payments happen to straddle a reporting date, this could have, a fairly significant impact on your accounting in terms of what are your trade receivable and your cash balance at the end of the period. So when this came up at the interpretations committee, the analysis done, I think, meant that in most situations, like you might expect, you would recognize the cash and you would de-recognize your receivable when you actually fully have that cash. So when the whole transfer has gone through and it is completed. So it's sort of when it's settled. And the reason this is now coming into an ISB project is not from that side. So it's actually from the other party's side. So when this interpretation committee discussion happened, there was quite a lot of concern about disruption to practice on the opposite side. So on the opposite side, we have someone sending cash and de-recognizing their trade payable. And often in practice today, many companies might do that at the date it initiates the payment. So you've sent off the payment and those journal entries happen straight away. Whereas actually looking into the analysis that was done at the interpretations committee, it would indicate that that should be happening when that payment is settled, not when it's initiated. And it was felt like if companies were needing to change their practice because of that, it could have quite a significant disruption with not necessarily the additional benefit there. So that's the reason this topic has come up.
And in terms of the next steps on this area, the ISB is proposing some narrow amendments to IFRS 9. Can you talk us through the proposed amendments?
Yeah, sure. So importantly, I think the amendments have two aspects to them. So the first aspect is clarifying the principle that's there. So that's clarifying the settlement date accounting principle. And I think it's important that that's included in the amendment, because I think one thing that's kind of been noted as part of the project is that it wasn't clear previously based on the requirements. And part of the point of having that clarification in there as well is that there will be an effective date for that amendment. So if companies do need to change their accounting policy as a response to this ISB project, there will be an effective date. And it also means our understanding is that there wouldn't be a prior period error. The second part, while it's clarifying the principle, is then actually to give a practical exception to that principle as well in response to the feedback about the practical concerns. And essentially that exception would allow companies a choice to continue de-recognizing the payable when the cash transfer is initiated if certain criteria have been met.
And what are some of your reflections on the proposed amendments? I mean, is there anything that you think might be challenged when the ISB considers feedback?
Yeah, sure. Good question. I mean, I guess maybe I'll get my crystal ball out for a moment. We've still got a while to see what feedback comes in. But I think generally we're expecting that the exception particularly will be welcomed to allow practice to continue in some areas. I'm at least anticipating that most of the feedback that we're going to see coming through to the ISB will likely be focused on the criteria to be able to use that practical exception. So for example, the criteria, it requires that there's the person sending the electronic cash transfer, they don't have an ability to withdraw or stop or cancel that payment. There's no practical ability to access the cash, and that there's very little settlement risk involved there as well. So I think that will be the main area of focus, mainly because it might require quite a lot of work to figure that out. And there might be cases where there might be slightly a grey line of exactly when the person that sent the payment can no longer access that cash. And there might be other interesting things that happen as well. So for example, as I said, some of these payments, they might take 3 days to come through. And it might be on the middle day, day 2, that the person who sent the payment no longer has access to that cash. And would it really be worth the benefit to use that exception on day 2 rather than day 1, and all these kinds of questions? So yeah, I think the focus will be on the criteria.
Thanks, Laura. So I guess a common theme on that side is the practical perspective of implementing the possible amendments and I guess the challenges there are from just getting comfortable with those criteria.
Exactly.
So I guess a final question then to both of you. Are there any other reflections that you'd like to share with our listeners on today's topic? So Mark, perhaps I'll come to you first.
Yeah, sure. I guess in short, if either of these are topics you feel passionately about, then the ISB want to hear from you. The deadline for submitting comment letters is the 19th of July. So still a bit of time left. But yeah, as with all these things, if you don't like it, then say, but also, yeah, be constructive. What is it that you don't like? What's your proposed solutions? The ISB always wants to hear that. Otherwise, complaints alone rarely get constructive feedback. So that'll be my one to flag.
Perfect. Anything, Laura, you'd like to share?
Yeah, maybe just the other thing, going off at a different angle, is just to mention that the post-implementation review of IFRS 9 is not over. There's currently feedback going on relating to the impairment requirements, and later this year we're expecting the board will also start looking into the hedging requirements. So yeah, this door isn't closed.
Thanks, guys. So with that, I'd like to thank you both, really. Mark, Laura, thanks for joining me today. It's been great to have shared your insights. And I think it's, it's such a, how would I say, definitely an interesting topic for me, but it's hitting a number of different areas that just goes to show there's lots more to IFRS 9 than the impairment. There's lots more happening on the classification and measurement side as well. So thanks again for joining us today.
Thank you.
And to wrap up the podcast, I'd like to share that it's actually now time for me to hand over the baton, so to say, to a new IFRS Talks host. It's been a pleasure to have been the host over the past year or so. And I think just reflecting on what we've achieved, we're at 143 episodes. And we recently had the notification that we hit total downloads of 250,000. So it's a fantastic achievement and definitely would not have been possible without our listeners and to all those that have joined me on the podcast. So big thank you to everyone that has supported us through that journey. And I'm really excited to announce that our new host is none other than Laura. So I hope you'll all join me in welcoming Laura as the new host of IFRS Talks. Laura, wish you all the best in the role. I'm sure you will be fantastic. And for the final time, I hope you enjoyed listening to the podcast today and that you found it useful. And until the next IFRS Talks podcast, happy accounting.
The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.